I was browsing through CNBC and came across this article. A researcher thinks that Tesla could be the most dangerous stock out there. So this of course piqued my interest and probably piqued your interest as well, because if you're a Tesla bull and you own Tesla shares, you want to know what the reasoning is behind this. You always want to go into an investment seeing both sides of the story. You don't want to be blinded to one side, ignore the bear case because you're a bull, or ignore the bull case because you're a bear. You want to be educated, and that's a trait that successful investors have. So this statement came from a gentleman by the name David Trainer, who is the CEO of New Constructs, which is a firm that does research on companies, and he calls Tesla the most dangerous stock on Wall Street because the fundamentals do not support such a high price and valuation. Pretty bold claims, but let's see what he has to say to back this up. By the way, if you haven't noticed, I've been doing quite a few Tesla videos recently, and if you've been enjoying those, hit the like button down below. I do enjoy this company. I do want to talk a lot more about this company on the channel, so I just want to make sure that you guys are enjoying it, and just based on the views, it seems like you are. But guys, hit that like button to let me know either way. So when I recorded this video, Tesla was not having the best of days, and it actually had one of its worst days ever, and it was down around 20% at the time of recording. Year to date though, the stock is still up nearly 300%, which is mind-boggling on its own, to say the least. But because of this run-up, many investors, even some bulls on Tesla, have raised concerns on bubble, overvalued-like behavior, or in this case, a stock that's dangerous because it doesn't reflect its fundamentals. Here's a quote from an interview from David Trainer. Whatever best case scenario you want to paint for what Tesla is going to do, whether they're going to produce 30 million cars in the next 10 years and get into the insurance business and have the same high margins as Toyota, which is the most efficient car company with scale of all time, even if you believe that all of this is true, the stock price is still implying that profits are going to be even bigger than that. David, no. This is exactly the wrong way to think about Tesla. Comparing Tesla to a traditional automaker is not what you're supposed to be doing here, because Tesla is much more than an auto company. And just ask any of the bears from 2019, may not be around anymore, but they were completely set on the fact that Tesla is an automaker. Tesla's market cap is more than Toyota. Tesla's market cap is more than VW, more than GM, more than Ford. Guys, doesn't matter. Tesla is not just a car company like these other companies are. Tesla is a battery company. They build some of the best batteries in the world, and this is going to be a massive business for them, because if these other automakers can't catch up, they're most likely going to have to license Tesla's batteries. Tesla is a software company. Full self-driving, autonomous driving, all these things are miles ahead of the competition. Tesla develops incredible software and technology, and that's a huge moat for them, because as we know, software companies, subscription companies, those are all the rage these days because there's high margins in that, and Tesla is heavily focused on that aspect of the business, which should turn tons of profits in the future. Tesla is a solar company, Tesla Energy. This is something that hasn't even picked up a lot of steam yet, but as Musk has kind of hinted to, he believes that the energy business of Tesla will probably be worth more than the automotive business of Tesla, and that's probably what some of Tesla bulls are realizing now, and that's why they keep buying the stock. But these analysts are still stuck in the olden age, thinking Tesla is just an auto company. Guys, please don't fall for that mistake. All I'm trying to say is that if you're valuing Tesla like you would Toyota or VW or BMW or any of the other companies, you're doing it wrong. All of those companies do one thing: they create internal combustion engines, ICE vehicles. Tesla does not do that. They don't create ICE vehicles, they create electric vehicles. Yes, so it is a car, but they've created a completely new market for them. They've created this little niche for people who want to have high performance, an affordable car, a good looking car, a car that you don't have to go and spend money on gas or, pollute the environment with and all that kind of stuff. Tesla is pretty much the vision for future travel. And I wouldn't be surprised if Tesla expands to other segments, like maybe a Tesla space program eventually with SpaceX, or maybe a Tesla boat, or whatever it is. Tesla wants to make sure the world is greener with their products. And from this quote, you can see that he is dead set on comparing Tesla to Toyota, for example, who is apparently the most successful manufacturer at scale. But you gotta ask yourself, guys, maybe that was in the past. Maybe Toyota was the best in the past. But in the future, what do they have going for them? they're the most affordable cars? Not really. Hyundai has a pretty affordable car now too. Ford has some pretty cheap cars. So that's not really an aspect they're winning. But what's the other argument? They have reliable cars? Yeah, I guess compared to like German cars perhaps. But let's not kid ourselves. Any car, even a Toyota, requires maintenance like oil and transmission fluids and all that kind of stuff. But an electric car doesn't have any of that. All you put in is some washer fluid. Maybe you gotta change up your wipers every once in a while, but guys, there's not really a comparison to draw here. Then Mr. Trainer goes on to say that the stock price is implying anywhere from a 40% to 110% market share based upon average selling price. He believes that the current average selling price of $57,000 and assuming 10.9 million car sales by 2030, it implies a 42% market share for Tesla. He then throws in that Tesla trades at 159 times forward earnings. So again, he goes back to the same point. Tesla is an automotive company and should be valued like an automotive company. And until he realizes that, there's really not much more I can say on this point. But what he also touches upon is the PE of Tesla, which is interesting. But what I want to do here is actually draw a comparison to another high PE, high growth company, disruptive company that everyone knows, Amazon. Here we can see a chart of Amazon, its EPS and its PE are pretty much listed on here as well. And we can see Amazon for the longest time was trading at ridiculous PEs. And in recent years it has come down, but it still sits at over 100 PE. So should we also not be holding or buying Amazon stock? Also keep in mind that Tesla, in my opinion, has potential to actually pull in more revenue than Amazon in the future, but that's for another video. So guys, in my opinion, valuing these type of companies on PE alone is a losing game. If you valued Netflix on PE, you would have missed out. If you valued Amazon on a PE, you would have missed out. If you value Shopify on a PE, you would have missed out. If you value these high growth stocks, the best performing stocks in the market on PE alone, you're going to miss out. So what do you do instead? You look at growth. Growth is what the market wants. Growth is what these companies keep going after because anything that they earn goes right back into the business and gets them growing even faster. And here's the thing, if all of these investments in growth pays off over time, profits will come. And we've seen that happen with Amazon. For the longest time, they've been burning cash, but they've been growing. And now finally, they've kind of switched things over and they're just pulling in so much money. But what I love about Amazon is that they haven't forgotten about their growth history and they just keep reinvesting in the business despite the earnings growing as well. And guys, I'm pretty much convinced here that Tesla is going to be on the same trajectory as Amazon has been. And they're going to pretty much be one of these companies that you're never really going to find fair value in. But you buy because you believe in the future of the business. You buy because the growth is still there on the fundamental level and the business just keeps executing on a phenomenal scale, which justifies a high premium. Now, Trainer also touched upon the recent stock split, so let's see what he had to say here. Stock splits are inconsequential to value. They're not changing the size, they're just dividing it up into more pieces. Honestly, I look at stock splits as a way to lure more unsuspecting, less sophisticated traders into just trying to chase the stock up, and that is not a real strategy. So I do agree with him here on some aspects because he speaks of fact. A stock split alone does not increase value in a company. Just because a company does a 5-for-1 or a 4-for-1 stock split, it does not make it worth so much more now because the valuation stays the same. Also, I will agree with the fact that stock splits typically do attract more investors. In the US, it's pretty accessible to go and get fractional shares from brokers, but around the world that's still not an option. So smaller size investors, when they see a share price of $100 versus $500, they're a lot more inclined to put that into the market and buy just a couple of shares versus before they've had to save up much more to just buy one share. This in turn leads to more buying and higher valuations. So yes, I guess what he is saying is true. What I find interesting is that Apple did the exact same thing at the same time. Both splits were effective the same day, but there's no mention on Apple doing this. There's no mention on, why did Apple do this to lure in more investors? It's only on Tesla because, that's the hot stock right now. That's the stock that short sellers just love bashing on and people just love being skeptical on. Wall Street has never been a fan of Tesla, and if you were an investor in Tesla in 2019, you know this firsthand. That's why we got such incredible prices to buy in at that point. And to to be honest, a lot of firms still, to this day, are still not seeing the Tesla story. And we can see this clearly from this article and from these points where he just compares Tesla to Toyota as an automotive company. But now the grand finale, we all know he doesn't really believe Tesla's valuation, so he revealed what he believes that Tesla should be worth. He says that the company should be worth a tenth of its value, and this was when it was at $500 per share post-split. He adds that Tesla doesn't rank in the top 10 in market share on car sales in Europe or car sales in Europe for EVs, and that's because the laws change in Europe. But again, look at Tesla from outside the lens, guys, of just an automaker, and then the potential for the company makes a lot more sense, in my opinion. He then finally says the stock should be worth more like $50, and this is where I just lost any sort of credibility for this guy. $50 a share post-split means that it was $250 or so pre-split, which equates to around a $50 billion market cap. In my humble opinion, I do not think we're going to see $50 billion market cap on Tesla again in our lifetime. I don't think that's going to happen. I don't think that the bulls on Tesla will ever let it get that low, because any dip that we see in this stock gets bought up quite quickly. And you can see that over time, ever since that breakout in 2019, we've just been making higher lows time after time. So clearly all this tells me is that he missed the boat on Tesla. He doesn't get the vision on Tesla. And unfortunately, there's so many people on Wall Street that still think this way. But I guess that's a good thing here for Tesla investors, because they keep throwing out these hit articles out there, hoping something will stick, hoping something will drive the price lower. And when that happens, investors like you and I can actually go in and pick up more shares at a cheaper price. So I guess we should be thanking these short sellers or these bears on Tesla stock, especially ones that don't really see the full vision for the company. Either way, guys, hope you enjoyed this video. Don't forget to hit that like button down below and subscribe for more Tesla videos. I'm going to be creating a lot more of these because you guys enjoy them. But don't worry, I will be creating other videos on the channel as well to kind of balance that out. Either way, guys, thank you so much for watching. Don't forget to invest positively, and I'll see you in the next one. Peace.